All right. Excellent. All right. We are up and running. Thank you guys for joining us. I'm Chris Ingram, CEO of Prosperitas Financial. Today, I have joining me my partner in crime, the far better looking and more stylish version of a financial advisor than myself, Mr. Robert Clark.
Thank you, sir.
Yeah.
I don't appreciate you lying to the audience on our very first start to the webinar.
That will be my only lie today, I
Yeah.
promise.
Perfect.
So again, thanks guys for joining us on our Q1 webinar. We're going to talk a little bit about this first quarter, talk a little bit about the remainder of 2024 and what we think that might look like, and then kind of go back and look at 2023 and kind of rehash what occurred during 2023 and some of the lessons we might have learned throughout the course of 2023. So let's go ahead and get started. We're going to try and keep this about 30 minutes. So let's see if we can keep that under that number. I have failed to do that in every previous webinar. So I'm not going to guarantee it, but I will try my best. So let's go ahead and go to that next slide there. All right. As I mentioned, we're going to talk about a couple of different things today. First of all, we're going to talk a little about the media. If you watched any of my previous webinars, maybe some of my videos, YouTube, whatever it may be, I talk about the media a lot, and I think it's important for you guys to understand what the media is doing to the average investor and how it negatively is impacting the decisions that they make with their investments, and why you should maybe take what they say with a grain of salt. We'll do what I said, a little bit of a market review, talk about what occurred last year, what we see this first quarter, talk about the upcoming election. That is probably the most common question I get right now, is what is going to happen with this election and how is it going to impact my investments? And then just a general look ahead at this year and what we see from maybe the Fed, interest rates, so on and so forth. Go ahead to that next slide. I'm going to start you guys out with a video, something we put together, a little compilation here, talk about that media that we had mentioned, give you some of the things that we saw last year and some of the things that we even said last year to kind of highlight our conversation about what the media has done to you, to your investments, and to some of the others out there, and what we can think about moving forward when it comes to listening to the media's recommendations. Go ahead and play that for us. If you go back to the fourth quarter of 2022, people being negative was a dime a dozen. There was, analysts on TV talking about how awful the markets were, how we were going into a recession, how you should sell all your tech stocks, get out of stocks. They were on TV. I went to a seminar in Vegas, listened to a couple of economists out there tell us, the sky is falling and that we should sell all of our stocks and get out of the market.
How long is this downdraft in assets and asset valuations going to last for?
So we'd expect kind of double the normal length of a recession because the Fed's not going to be at your back for a long time. And that's a big deal.
All of the dominoes have started.
Yeah, you can see the fall of the domino starting. You can see it as like, who has the cash? How much cash do you have that are going to get you through? Are you going to have a year or two or three, or don't you have the cash? And the dominoes usually fall in the same kind of ways, and they're falling in the same kind of ways.
So tell me where I'm supposed to go hide out in this. Do I sit in cash for the next few years?
Well, I think first off, cash at these levels is competitive.
25 years, the biggest mistake clients make is getting out at the bottom in anticipation of things getting worse. And while they will get worse for the economy, the market's probably going to start rallying 6 to 7 months prior to that. So best thing to do when you're in that type of situation is stay in there, hang in, understand this information, understand why it's like this, and that going back to 1950, these are the numbers. This is what it looks like time and time again. Excellent. Let's go ahead and go to that next slide. So one of the lessons we learn as we build this out is that I couldn't hear that video, so I was gonna, I'm glad you guys heard it, but I can't hit on exactly all the different things that were said in there because I don't know exactly what was said other than what I remember when I watched the video myself earlier. But, here's the long story short. and we talked about it several times going into, one of those videos that I recorded there was at the end of 2022 talking about, I think Robert mentioned, it was actually on the exact same day that the gentleman from Bridgewater, right?
Yep.
Was making his comment on CNBC, talking about, get out of stocks, go into cash, cash is king. And we're saying, hey, stay the course. This is what happens time and time again. And so, I think the key takeaway is when you listen to the media tends to be relatively negative, gloomy. They're always looking for, wanting to predict the next bad market and tell everybody all these things that are going to happen. It drives headlines, it drives attention, and it tends to be the focus of the media. And so people get caught up in that and they want to make big dramatic changes to their overall portfolio. The problem with that is that those big dramatic changes are what devastate a portfolio over time. And so what we're not saying is that I'm a genius or Robert's a genius and we know exactly what's going to happen next in the market. What we are saying is that nobody really knows. These people that sit on TV and act like they know exactly what's going to happen next, and that you should make these big dramatic moves in your portfolio based on what they see, time and time again, they have proven that they're wrong. And if you listen to what they said, you're going to devastate the long-term returns and the value of your portfolio over the long term. So we always preach incremental moves to your portfolio, small incremental base hits, little things to keep your portfolio moving, make minor adjustments, but no big sweeping changes that are going to devastate the portfolio if you're wrong. And staying the course long term, understanding what are your goals, what is your time horizon, what are you trying to accomplish, and understanding that you're in the right portfolio based on what your goals and objectives are, and that you kind of stay the course long term while making some incremental moves, but no big sweeping in and out changes to your overall portfolio.
Yeah. To your point, Chris, if you look at one of these article clippings there at the top talking about Michael Burry saying that he's betting against the tech stocks. I don't know if you can see the date on that article. That's August of 2023. So if you're paying attention at all to the stock market and what 2023 did, getting out or betting against, even worse, betting against tech stocks in August of last year would have completely demolished your portfolio.
Yeah, absolutely. And I'll even use some numbers, and I don't have the exact numbers in front of me. I was supposed to have them in front of me, but our tech and innovation portfolio was up 96% last year. And I think we're up another 25% year to date. So think about that. If you would have gotten out or bet against tech stocks based on what you heard Michael Burry say, you think, hey, Michael Burry, he's famous for that movie, The Big Short, and he knows what he's talking about, right? And if you listen to him and you bet against the market, you probably had a really a tough time over the last 6 months when you watch tech stocks rally and your portfolio do exactly the opposite to that. So we just, again, no big major changes, like minor adjustments, based on what you're seeing from the market environment, but jumping all in, all out, making big bets, that's Vegas, that's gambling, that's speculation. That's not what we do here. We're looking more long-term and looking for a more even-keeled run in the markets and in your portfolios over time.
Yeah. If Minika, if you want to head to the next slide, this was really interesting. And, really the why does the media paint this fear picture, or why do these people come out of the woodworks with these big theories and these big headlines? Well, it's because it gets your attention and it makes people take action. It's not always the right action, but what we're looking at here on this graph is really from the year 2000 to the year 2019. It's looking at the comparison or the ratio of positive headlines to negative headlines. And so you can see in 2000, there was actually more positive headlines than negative, and you can see that downslope to where we are today. This doesn't even include COVID and all the headlines in the news that happened during the pandemic. So really just, again, painting the picture of what the media wants you to do is to waste time digging deep on all of these fear-based headlines, kind of hiding and staying out of a lot of these things. And so that's why we really want to ignore that as much as possible when it comes to your investments and your financial future, because you cannot take a risk making the wrong move there.
Yeah, those can be huge. Those moves, You know, it's one thing if the market goes up 20% and you go up 18%. It's another thing when the market goes up 20% and you're down 3% or you don't participate at all. The lost opportunity cost over time, if you understand how compounding interest works, missing out on that opportunity can be really devastating to long-term wealth in your portfolio and the success of you accomplishing your goals in the future. And if you know, I don't know who's watching, but depending on your financial advisor you work with at our firm, whether that's Jeremy Leibowitz or Jen Brown or Jerry Citarella or so on and so forth, you know, they're all keyed into what are you trying to accomplish? What are your goals? What are you looking for your life to look like in the future? And they're positioning you into a portfolio that's appropriate to try and get you to those goals in the most efficient way possible. And that is staying the course. That's riding the ups and downs of the market. And they've got you in the portfolio to be able to weather those storms of the ups and downs over time. So jumping in and out is not necessary. They've got you in the right portfolio based on what your objectives, your specific goals are. Next slide for us. This is a gentleman that I actually saw him speak live many, many years ago. I think it was somewhere around 2000, 2001. Nick Murray, he wrote a great book called The Excellent Investment Advisor. He says wealth isn't primarily determined by investment performance, but by investor behavior. And this is something that I've talked about a lot also. They say and I don't have the specific data in front of me, it's something like the average mutual fund on the planet is averaging somewhere around 8.5%, and the average investor is doing 3.5%. It's not the mutual fund's fault. It's not that investment that you own. It's not its fault. It's the investor's fault for trying to jump in and out of the market and time the market based on this fear and anxiety that is typically driven by the media. 2018, 2020, 2022, all of these fear-driven headlines that, as Robert pointed out, are getting worse and worse over time with more access to TV, social media, Facebook, internet, all this stuff. You're getting more and more fear-based headlines put in front of you, and it's detrimental for you to be listening to a lot of that information.
Completely agree. All
Cool.
right, let's get to the market update.
Yeah.
Next slide. Cool. And one more. Thank you. So what we're looking at here is the S&P 500 returns over year to year since 1991. Okay, what this graph is telling us is really unique to last year. Now, the S&P 500 was up, I believe, 25% last year, something in that
Right around
in
there.
that range. I mean, that's a knockout year for an indices or an index as basic as the S&P 500. Again, what we do at Prosperitas is we try and uncover, okay, what's going on, what's driving that, and how do we forecast that and be prepared for what might come next. One of the interesting data points out of our investment management team was uncovering that only 28% of the S&P 500 companies actually drove or outperformed that total S&P 500 index. So
And that's in 2023.
and that's in 2023. So as a benchmark, what this graph is telling us is that usually 49% of the S&P 500 companies beat the S&P 500 as a whole. So when we're down at 28%, that's telling us there's only a handful of companies really carrying the weight of that whole S&P 500 index. And so as investment advisors, we want to be paying attention to, okay, well, what companies are really carrying this performance and this strength? Because why hold on to, you know, some of the ones that are weighing down the portfolio or creating drag on the portfolio? And again, the news isn't talking about data like this. And so this is something that we want to pay attention to, at least to be making more educated investment decisions when it comes to you and your portfolios.
Absolutely. And you guys have probably heard of the Magnificent Seven. That's what they're calling them now. These big 7 tech stocks that are the biggest companies in the world that tend to be dragging the market along with them in the NASDAQ, in the S&P 500. They're the main source of this, that they're driving so much of this growth, which is important to understand. but it's also important not to get so hung up on it that you just start putting your entire portfolio into those 7 companies. You got to understand that while they are driving the growth right now, and they're important to the overall allocation and how your portfolio is going to be managed, we also don't want to get into a place where we're throwing all our eggs into that basket and potentially, increasing the level of risk in our portfolios when it's either not necessary or not appropriate for whatever our goals may be.
Yep.
Let's go on to the next
Agreed.
one there.
Cool. Just a quick first quarter update. So now we'll look at specifically the first 3 months of the year. Unemployment's coming in at 3.8%, pretty normal for where we've been lately. No major changes there. Our 12-month trailing GDP growth is about 5.8%. Again, pretty similar. We're going to get updated GDP data at the end of April, so we're always paying attention to that. And as you may or may not have heard from this morning, our latest inflation data, we're now at 3.5% from where we were last March to this March. Previously in February, it was 3.15%. So the reason the markets were down today and not taking we're not liking that news is because it's saying, hey, maybe this inflation thing isn't quite tamed. Maybe we're not quite ready for the Fed to lower interest rates as quickly as we were hoping. So we saw the market react to that. Is this coming as a surprise to anyone here? No, not really. We're going to be floating around this 3 to 4% number for a while. It takes a while to bring costs down. The consumer is still out there spending money. That's very clear. And so until that really subsides, I don't think we're going to see a major change in that inflation data.
Yeah. And I'd go back to our discussion about the media a little bit. A lot of what I'm seeing right now is people continuing to say, we didn't get it right last year. We were wrong. We didn't go into a recession, but it's coming, So you get a lot of that too, where they don't want to just completely admit they were wrong. They're going to say we were early, but it's still coming. But when we look at a lot of this data and you look at, unemployment, the labor markets and the jobs reports that we've received recently are very encouraging for the way the labor market looks. You've got GDP growth that is outstanding right now, should actually slow down a little bit. And you've got inflation that, while it's not at the 2% target that the Fed is looking for to start lowering interest rates, it's definitely on that lower end and has been relatively tame. Obviously, the number today was not a number that they liked, and it may push off that first rate cut a little bit further. But those rate cuts are coming. The Fed wants to lower interest rates. They're looking for a reason. So give them a little bit more data that they can key off of, and they're going to come eventually. It's just a matter of when.
Cool.
Looking back at, first quarter of this year. So it's been a great year, but it kind of goes back to what we were saying before with the leaders versus the overall markets, right? So you look at those top 2 lines, that purple and green line, that's the NASDAQ and the S&P 500, up just shy of 10% year to date. Again, driven heavily by those magnificent 7 or those big tech stocks that are in there. You've got that blue line, that's the Dow Jones. So here's 30 more industrial, more dividend value companies, up about 4.5%. You got that black line, we're looking at some international investments up about 4%. You've got small cap or small companies up about 3.5%. And then you look at that yellow line, well, that's the bond market. So the bond market is still struggling. Had a good 2023, but it's starting to struggle again here going into 2024, down 2.3%. So another thing to understand is that when you're in a diversified portfolio, and broadly diversified, where you own small caps and international and value companies and all these different areas of the market, yes, the S&P is up, roughly 10% year to date. But again, you're talking about a small segment of the market that is really performing very, very well. I think, just a good example is NVIDIA, I think, is up 75% year to date just since the beginning of the year. So you're talking about a handful of companies that are really dragging those areas of the market up. And some of the other areas that are not bad investments, they're just more tame at the moment, let's call it, when you talk about value companies or what's going on overseas or whatever it may be. This is data as portfolio managers, we very much are looking at. We're not looking at it because we want to change what happens with your portfolio over the next 3 months. We're still very much keyed in on where are we going to be 3, 5, 10 years from now. So we're not so concerned with what's happening in the short term, but we're very much taking this information into account when we make adjustments to the overall portfolio. Where are we making money? Where should we be positioned based on what the market environment is throwing at us? You take this one.
Okay, you
Yeah.
got it. So, going back to those Fed rate cuts, and again, a reason why the market today specifically wouldn't like the idea of maybe postponing some of that. We want to pay attention to, what's really priced into the stock market. What are most investors expecting happens by the end of this year when it comes to what the Fed chooses to do? As we've seen the last 4 or 5, maybe even longer than that, maybe looking back 10 years, we've realized that, the stock market, its ebbs and flows really tie in with what the Fed's doing with interest rates. That's been a huge influence in stock performance. And so one of the things that we like to look at, again, just another piece of information that feeds our investment committee is where are investors pricing in where we'll be by the end of this year with the federal funds rate, with the interest rates. And so you can see that currently we're on that far right. We're at the 525 to 550 points. That's our current Fed funds rate. And you can see that, really a majority of the investors are expecting that we go down about 75 basis points by the end of this year, whether that's, 2 rate cuts, maybe 3, is interchangeable. We're really just looking at, okay, where do investors expect us to be? And that's kind of how they're making their investment decisions in today's world.
Yeah, and I think, to understand from a portfolio management standpoint, if we start to see that you're not going to get those 75 basis points, you're going to get far less than that for whatever reason, because the market's already kind of priced that in, you can expect some kind of a pullback or an adjustment in the market. So, and if we overshoot that, if all of a sudden we think we're going to get a full, percentage point or more in rate cuts between the end of the year, that's more than what most are expecting. You can expect the market's going to rally on that type of information. So it's important to know where expectations lie, so that you can start, as data comes out, start to pivot and adjust based on the new information that you receive and where we think things will be at the end of the year versus where expectations are. And this is a good chart to show that.
Perfect. Next slide.
Oh, the election.
Yeah.
If you're listening, hey, if you're not listening to our podcast, go check out the Advice First podcast. We're on all the major areas and places that you can get it. YouTube channel. I think we also post them to the YouTube channel. One of the questions I'm asking all of our advisors, we're having a little competition, is, who they think the next president is going to be. And, it's going to be all over the place. But, that's the question, right? Who is going to be the next president by the time we reach the end of this year? And there's a lot of concerns that revolve around that. One of the most common questions I get right now is if so-and-so takes office, what is that going to do to my portfolio? And a lot of times it's based on that individual's own political beliefs. So I can have somebody that will say, oh my gosh, if Biden gets reelected, that's going to be bad for my portfolio, right? And then I can have another person, an hour later come in my office and go, gosh, if Trump gets elected, it's going to be terrible for my portfolio. So some of that is based on their own personal beliefs of what they think the next president should be, and how that's going to, influence their lives, the country, the economy, their portfolios, so on and so forth. But when we actually dig into the data on this next slide here, you'll start to see what I tell people a lot, which is it really doesn't matter. This is going back, since, early 1930s, and looking at the different presidential parties that have been in office and what the returns for the portfolios or for the markets have been over that time period. And you can see that, it really kind of doesn't matter who's in office. The markets are going to kind of do their thing, first of all. And you also have to remember that the markets are more driven by what is corporate America doing? What is the economy doing? Are we making money? Are they growing? All of those things are far more important than who the president is. Some of the president's political policies may adjust or change the outcome of that, but some of it is immune to that. I mean, if I'm a company, I feel like I can turn a profit regardless of who the next president is, right? So our company, I feel very comfortable regardless of who the next president is, that we're going to do well, we're going to grow, and we're going to turn a profit. So a lot of companies feel that same way. And as long as companies in corporate America continues to put up the numbers, their stocks will do well, the markets will do well, so on and so forth. One of the things I do touch on a lot with clients is that a lot of returns for the market happen post-election. And a lot of that comes from the uncertainty of who is the next president. And then once you know who the next president is going to be, a lot of money will flood into stocks that they feel are going to benefit from the political policies of that individual president. So, you might have, let's just use Biden, for example. When Biden took office last time, you saw a lot of money flood into energy efficient or electric vehicles, those types of things. And when Trump took office the time before that, you saw a lot of big business, technology took off, energy took off, some of those kinds of sectors that they thought would benefit most from Trump and his political policies took off. So it's less about will the market do well and more about should we reposition and shuffle around our investments to be more in line with the political views or, what their policies may look like moving forward.
Yeah.
Go ahead to that next slide. This is just kind of another year by year look at the different political parties when they're office and what the markets have done. And again, what you can kind of see is that there's really no rhyme or reason based on who or what political party is in power, and more about what time of the year was it, and what was the economy like, and what was the overall feeling of the economy and what was going on here in the US during that time period, and less to do with, which political party was actually in power.
Yep. Spot on.
2024 outlook and opportunities. You want to take this one?
Sure. Yeah, let's jump to the next slide. So, again, as Chris mentioned, it's different being an election year. You're going to hear a lot of noise, hence why we touched on media and your investments. And so we want to make sure that you're armed with, okay, what do you do with this? What's our outlook? What are we paying attention to for the rest of this year? And how can we best position you for a successful retirement? Whatever your goals are at hand, here's some of the things that we're looking at that impact or influence the decisions we're making within our team. So one of the key data points, and it's funny, when I talk to people about this, when we think about December 2022, and we were at a low point in the stock market, and everyone thought, man, next year we're already in a recession, right? It is nearly guaranteed. 85% of respondents on this survey said by 2023, we will be full in a recession. Well, look where we are today. We do that same survey 12 months later. The only thing that has changed is consumer sentiment, right? The stock market recovered. Consumer sentiment gets more positive. Now what we're looking at is over half, 63% of those survey responses are now saying no recession until at least 2025, if not after that. And so it's just interesting to, again, the media plays on the fears and the anxiety that you might be thinking through. And so, in December, at a very low point in the stock market, everyone thinks a recession's around the corner, no matter what. And we can just see to where that's shifting today. Obviously, December 2023, the market was in the middle of a impressive bull rally, still kind of feeling the after effects of that. And so, again, stay the course. Don't buy into what the headline's saying, and really, it's going to play out the right way for you as long as we just stick to our guns and stick to our keep our goals, kind of the main point.
Yeah, I just want to throw something out there. Probably the greatest lesson I've ever learned as an investor. And it's interesting that I'm going to use this quote because he kind of did the opposite last year. And I feel bad he missed the mark last year. But Warren Buffett is still one of the greatest investors of all time. So he was off last year. They sat on a lot of cash in 2023. They were anticipating a recession. So there was some headlines out there showing, that they were really kind of on the opposite side of that. But one of his quotes, and I quote him all the time, is be fearful when others are greedy, be greedy when others are fearful. And if you can do one thing that will change the whole outcome of how your money does, what your portfolios look like over time, is when things look most dire and nobody wants anything to do with the stock market, is to put money into the stock market. And when your neighbor comes to you and tells you how well he is doing in his own private individual portfolio, and he has literally become a genius stock picker and the market is at its all-time highs, that's when you should start to get nervous and think about taking some profits and making adjustments to your portfolio. And if you can go against the grain and be the opposite of those two things, you will be far more successful in the long run just by making those two little tiny adjustments and be the opposite of what your gut. And sometimes I use that when my gut starts to get scared because the world looks like it's coming to an end. That's when I'm like, oh, I should probably put some money into the market. And when I'm like, everything's great, it's going to be awesome, we're making tons of money, that's when I'm like, oh, maybe it's time. I need to go the opposite of my gut and start pulling some money out of those investments and taking a little bit of profit. So take that and just keep that. That's probably the number one lesson I can say everybody needs to learn.
Love it. Next slide, please. Awesome. So, going back to why didn't we go through a recession? Everyone saw it on the radar or was anticipating we're going through a recession. And one of the interesting things that our investment management team pulled out of the data is that, a recession takes an involvement from every single party involved, right? So every sector, we're talking about travel, consumer spending, the corporations, all of them are participating in a recession. What's really interesting is that over the last few years, each little sector, I shouldn't say little, each sector within our economy has had their own form of a recession. So here on the top left, we're seeing TSA travelers. There was a major dip, obviously, in COVID during the pandemic, as to be expected. But what's that create? It creates its own recovery. We see the same for oil on the right. 2020, oil dips below into recessionary territory for oil specifically, and that recovers. Then even more recently, we've seen the same with housing. Last year, housing numbers were starting to fall off. There weren't as many transactions as houses selling. Now we're starting to see that pick back up as the Fed hints towards potentially lowering rates. There's still, at least in Southern California, in our submarket here, there's still a very high demand for housing. And then if we go on to the semiconductors business, 2022 was also not the greatest year for that specific sector. And so we're kind of in a position to where each of these key sectors and key aspects of the economy have had their own slow seasons. And so that's one of the things that we can reason, hey, maybe this is one of the contributing factors to why we haven't had a broader recession. And for those people saying a recession is still inevitable, well, this is the data that we point to say, it may have already happened. And so that's why we need to have a more objective outlook going forward.
Yeah. And I'd say if you don't follow me on Facebook, and it's more my personal page, but I do post business stuff there from time to time. I said at the end of the second quarter of 2022, we had negative GDP first quarter of 2022 and negative GDP in the second quarter of 2022. They came out and said, well, that's not really a recession. It's always been 2 consecutive quarters constitutes a recession. They came out and said, well, there's other factors involved. It doesn't really feel like we're in a recession yet. It's still coming, that kind of thing. I made an argument at that time, that we were already in that recession and that we were working our way out through the backside of that. And when you look at some of the data in housing, in semiconductors, in the markets in general, in some of these like sub markets, it really did feel like that recession started earlier and carried through the first 3 quarter ish of 2022. And that's why we started seeing it recover and work its way out through the tail end of 2022 going into 2023.
Next slide. Go for it.
Yeah. So where's the opportunities and outlook? So this is another question I get a lot. Are we invested in AI? And how do we benefit from this artificial intelligence move that is happening, that's going to change the way we do everything? And so the first question is, yes, we are very much involved in what's happening with artificial intelligence. What we want people to understand is that it's not just those artificial intelligence AI names that we want to own. We want to understand who are going to be the primary beneficiaries of that technology when they implement it and deploy it in their own businesses. So you'll see, obviously, semiconductors. So you got NVIDIA, again, the leader of the pack, and they're having this huge run, obviously, because they are that chip that's going to power all of this artificial intelligence, right? You've got Microsoft with ChatGPT and Amazon and Google with their own AI technology that are leading the way in the first version of what artificial intelligence and AI technology looks like. But you got to also look at, how is it going to impact financial services? How is it going to impact healthcare and pharma, the legal and professional services, automotive industries? There's so many other industries that as they take this technology and start to implement it in their own businesses, that they're going to cut costs, increase efficiencies, better their business moving forward, which is going to be a huge thing for them. And there's a ton of opportunity in some of these names that people aren't looking at and maybe haven't run yet, right? There's still opportunity because people haven't jumped on that bandwagon already. And that's what we're looking for. We're looking for what are those other companies that maybe 2-3 years from now, we're like, oh man, they really killed it by being able to implement that AI technology in their own business structure and what they do best.
Yep, exactly right. Next slide. And so I think this is, to answer that proposition Chris just created of where are we looking, one of the things that really stands out is the dividend paying stocks, the high dividend paying stocks are at a value being valued so low that the last time we saw them at a similar place, they actually were some of the biggest drivers to stock market strength. And so, not to say we want to go all in on those, as Chris has mentioned multiple times, it's these small adjustments, but we're looking for, okay, which high dividend players could benefit from things like artificial intelligence, from all of these technological advancements, and which would be ripe for the picking to add into our portfolios over the next 3, 5, 10 years. And so this was a very interesting statistic that our investment committee drove up for us. And so something we're actively paying attention to.
Yeah. And again, be fearful when others are greedy when others are fearful, right? You've got everybody wants to own NVIDIA now after it's up, whatever, 200, 250%, right? Now's the time to start thinking about, hey, let's take some profits in some of these names that have had these huge runs and valuations have been stretched, and go look for opportunity in companies that are appropriately valued, maybe undervalued, that people haven't caught on to yet, that are going to benefit from this next wave. And overall adjust risk in our portfolios and make sure that we're keeping in mind, what the long-term objective is for the portfolio overall.
Yeah.
Yeah. So that's the majority of what we wanted to share today. I don't know how I did on time, but hopefully we kept it under that 30-minute mark. The one thing we do want to bring to your guys' attention is we love you guys. We want to spend time with you. And we have a lot of clients now with all of the different advisors that are at the practice. And I haven't met all of you. Maybe some of you listening, I've never had the chance of being able to communicate with you or meet you in person. And so we have an event coming up. Next slide. On May the 4th. So if you're a Star Wars fan, please feel free to wear your Star Wars gear on May the 4th. But we're going to be at Lucky Luke's Brewing Company from 12 to 3 for a little bit of a client appreciation event. We're going to have some games set up and some fun stuff to do. And again, more importantly is just put a face with the name. We would love an opportunity to hang out with you guys for a little while and get to meet each and every one of you. So if you're around on that date and you've got your lightsaber ready to go, please feel free to join us and come say hi.
Are you going to wear your Darth Vader outfit?
No, I should though, but
You
I'm not
should.
going to. That's too
Come
much
on.
of, then I'm too much of a Star Wars nerd and I can't do that.
Give-
So we won't do that. But hey, it was great hanging out with you guys. Thank you for tuning in and checking out that first quarter webinar. If you have any questions, please feel free. You can always reach out to any of us, but reach out to your advisor and let them know if you have any questions based on the information that we've delivered to you today. And let's have a really successful 2024. And hopefully we can see you guys at Lucky Luke's on May the 4th. We'll talk to you guys soon.
Advisory services offered through Prosperitas Financial, an investment advisor registered with the U.S. Securities and Exchange Commission. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Prosperitas Financial and do not offer tax or legal advice.